behalf of our Commissioner, Rosa Escareno, I want to inform you that business licenses can be processed online where applicable by visiting www.chicagobusinessdirect.org. Beginning Tuesday, July 6th, all BACP offices are open to the limited members of the public. Please be advised that masks are required in all BACP facilities and 6 feet of social distancing must be maintained at all times. While offices are open to the public, we continue to strongly discourage in-person visits. If you are part of the BACP Entrepreneur Certificate Program, you could get credit by joining this webinar by sending an email to bacpoutreach@cityofchicago.org. I will put that in the chat. If you want to learn about the program, please visit chicago.gov/business-education. Also, you can receive targeted emergency alerts for business community by opting in to Shy Biz Emergency Alerts. If you're interested, please visit chicago.gov/Shy Biz Alerts. We encourage all attendees to ask questions. Please use the chat box and send your questions to all panelists. There will be a Q&A session at the end of the presentation. Today's webinar is Fund Your Startup into a Real Business, and I am passing over the mic to Hannah Fernandez from SCORE.
Thank you so much, Geraldine and the Chicago BACP team. We truly appreciate our continued partnership and collaboration. Hi, everyone. Thank you for joining us for our Fund Your Startup into a Real Business webinar. If you want to know the various options to fund your startup, then you're in the right place. My name is Hannah Fernandez, and I'm the chapter chair of SCORE Chicago. SCORE has been around as a resource partner of the SBA since 1964, providing free and confidential business mentoring for business owners across the country. So whether you are a new entrepreneur or you've been in business for a long time, our SCORE mentors could help you start, grow, and scale your businesses. To schedule an appointment with our mentors, go to our website at chicago.score.org. Now, I'd like to introduce our presenter, Jeff Nicholson. With over 33 years of commercial and investment banking experience, Jeff was responsible for client coverage activities of diversified companies in the central United States. He has had the opportunity to observe and work with managers and owners across a wide range of industries, from large public multinationals to small privately held companies. During 17 of those years, he was also a successful adjunct instructor at both the undergraduate and graduate levels in both management and finance. Jeff, you're on.
Hi, Jeff, you're on mute.
Sorry about that. Can you hear me now?
Yes, nice and clear.
I apologize for that. Good morning to everybody. I will be your guide today for financing your startup. I really appreciate everyone who is listening in. When I was first asked to build this webinar, I thought, you know, all you need to do is sketch out your great idea on a napkin and people will throw money at you. Well, not really. Now I've got a problem with my slide advance. All right.
There we go.
This is a much more appropriate quote. This was given by Tim O'Reilly, who actually was the creator of the first internet web portal in 1993. Money is like gasoline during a road trip. You don't want to run out of gas. Our goal today is to learn a lot more about financing startups. And quite candidly, most people don't know diddly about it. But we are going to cover a lot of material a mile wide and an inch deep. And so what I like to say is fasten your seatbelts. Let's just set the stage here by taking a look at the big picture. Look at these stages during the life cycle of a startup business, actually of any business. There's roughly 9. And this workshop is only going to deal with the 5 highlighted stages shown with a red halo. Most of the stuff you can read, most of the stuff you can find on the internet, and most of the workshops you can go to are all about those stages that are not highlighted. And that's why this workshop has been put together. Inc. magazine went to its 500 founders, which are the 500 fastest growing companies in America, and asked them to think back to their first year in business and identify what they thought was their biggest mistake or their biggest challenge during that first year. And this is the result of the survey. Notice how distant number 2 is, but the number 1 mistake or challenge for the Inc. 500 was not enough capital. The SBA states that the average cost of starting a business is around $30,000, and most will be able to successfully launch with under $100,000. A sound business plan includes specific financial projections, including total startup costs. And estimating startup costs are as much about sales forecasting as it is about expense projections. Investors and lenders will want to know specifically where their funds are going to be used in the business. So I like to say you start with yourself. No one else is going to invest in your business if you are not willing to invest in your business. And we call that bootstrapping. After that, you have to get out a pad of paper and begin to list other sources that you might want to tap. And a key objective of this workshop is to help you formulate that list of possibilities. What form will the funding take? Will it be donation-based? Will it use loans? Will any of the funding come from sources that require an ownership stake in your business? And as you're putting your thoughts together on these various sources, you also need to cultivate a funding strategy. And by strategy, I mean A, the mix of sources you plan to use, B, the specific milestones in your journey that determine how much and when the funding is needed, and C, how do you plan to approach each source in the process? Now, returning to that Inc. 500 survey, another question was asked: how much money did you use to start your business? And if you look, those answers aren't that far off from what the SBA said. Only 18% replied $50,000 or more, and well over half said less than $10,000. So continuing with that founders survey again, these are the sources that those founders used. 71% used personal savings. That's what we call bootstrapping. By far the vast majority. 21% said family and friends. And we will talk about that specifically. Both personal and home equity loans together represented 25%, which happens to be a little bit of personal risk taking because you're putting your personal assets at risk because it's not a loan to the business. You notice only 9% from angel funding, and which we'll talk about later, and 6% from venture capital firms. You'll notice that there are no mention of bank loans, and SBA guaranteed loans only represent a minuscule 3% of the total. So with that as background, How do you get started on this quest? Well, I would start by asking two basic questions. How much money is needed? And how will it be used? And where most people start is trying to identify, well, what are my startup costs? Most people make the mistake of thinking startup costs only accumulate until the business is launched. But that is not true. Startup costs accumulate until your business breaks even. Up until that time, you have to cover all your operating losses until you break even. So the reality is you have to include capital expenditures, which don't appear on your income statement because it's a cash outlay that shows up on your balance sheet. So operating losses, capital expenditures, and also net working capital has to be covered. Now, maybe most of you aren't familiar with the term net working capital, so let me see if I can explain it to you. Assume for the moment that you're a manufacturer and you're going to make some products. You're going to have to transform them from raw materials into finished goods and then sell them to your customers. So on day one, you make an order for the raw materials that you need from your suppliers. But because you're a startup, you're probably going to have to pay on day one. So the money goes out the door day one for those raw materials. And then the company will package your purchase. They will ship it to you. And let's say that that takes 2 weeks for you to get it prepared for processing. And let's assume that it takes another 2 weeks for you to make all of those raw materials into finished goods. So now you've gone a month worth of time where the money went out the door day one, and after 30 days, you still haven't recovered a single dollar of sales. So in month two, you're going to go ahead and start selling this product to your customer base. But most of your customers are probably been in business for a while, so they're going to ask for payment terms, meaning you're going to ship the goods and they'll pay you in 30 days. So you put the money out day one, and it may be 60 to 90 days before you get your money from the sales to be able to pay for what you bought the inventory for in day one. That carrying time has to be financed, either by bank loans or by your cash. And until you recoup the sales dollars, you're out that initial purchase. So that's the whole concept of net working capital. Excuse me. So as you develop your projections for startup costs, it's a two-part process. You've got those one-time startup costs, which are like setting up your website, getting the legal costs for setting up your company, getting established with the state of Illinois, getting your brochures printed, your business cards done, all of that. But then beyond that, you have your monthly operating expenses that you have to finance until you get break even. And that may be anywhere from 6 months to a year or more before you do that. And if your household is going to be dependent upon the startup business, then you have to factor in your personal living expenses as well. So look at this graph. This is what break even is all about in startup costs. On the far left edge is the launch day one. But afterwards, your business will still need to operate until you reach break even, which is where the yellow arrow is. And until you break even, you need to cover or fund any operating losses until your dream becomes profitable. And so that's the whole business of startup costs. You need to also, as you're thinking about startup costs, plan for contingencies or the unexpected. You know, if you're building a building today, you've got some very experienced engineers, some great architects, and some contractors who have done this repeatedly. But you will fail to get any kind of business financing for that building unless you have a contingency factor in your budget for somewhere between 8 and 12%. And that's to cover things that you just don't expect to bump into, but it's there as a cushion, and that needs to be part of the budget in order for a bank to provide the financing for the building. And that's important for you to consider, to have some leeway in what you're doing on the startup side. You don't skimp on necessities like, gee, I can't afford insurance right now, I'll get it later. That's a skimp that isn't appropriate. You can always consider ways to economize later, but you definitely need to take your financials and the assumptions behind them and get a reality check or two. I mean, that's what's great about SCORE Mentors, is you can take your whole startup profile and what's going into it from your perspective, share that with a mentor or two, and ask them to respond and ask you questions and challenge your thinking to make sure that you've got everything buttoned up pretty well. But the number one thing is, if you don't have enough cash to start your business right, wait until you do. Now, everybody write this down. www.5minuteclasses.com. So when you go to that website, you want to get to a YouTube video, how to calculate startup costs. It's a great video. It's only 5 minutes. And there's also suggested worksheets to follow in order to accumulate all of the things you need from a startup perspective. The other thing I think you should always have in the back of your mind is that you should try to get customers to make prepayments or deposits for the orders that they give you. You may not get it right away. You may not get it for a while, but in as much as you can get any advanced payments products that you're selling, it helps decrease the amount of net working capital that you have to finance. And you should always try to get payment terms from your supplier. You probably won't get many out of the gate, but as you successfully pay your bills and work with them, you should ask for a net 30 transaction, or even a net 10 or net 7. Anything that delays the amount of payment that you have to give a supplier is helping with your net working capital. Now, as I mentioned before, if your household is dependent upon the success of the startup, then you need to incorporate those household expenses in your financial startup costs. Now, you might be asking, well, how do I put all this stuff together? Where do I put it? Well, I believe you can download the best Excel spreadsheet for compiling financial projections for free. You just go to score.org and enter financial projections template in the search box. The search will result in the template, which you can download, an Excel spreadsheet, actually an Excel workbook. It has input sheets where you can enter all of your assumptions, and it provides some suggestions in the process. So you can put down, for example, all your monthly sales by product with the volumes and the numbers and all that. You can put down employee salaries if you've got employees, and you can do that on a monthly basis for the first year in whatever kind of detail you have available. And it will accumulate all of that information. And once completed, the workbook generates income statements. It's monthly for the first year and then annually thereafter. It generates balance sheets and cash flow statements. It also has a break-even tab, so you can identify what volume of products you have to sell in order to break even. And it also provides a set of ratios so that you can analyze your performance or have your accountant or banker analyze your performance. In addition, there is a 40-page user's guide, which you can also download for free. It gives you a lot of suggestions on how to think through using the workbook in each of the sections that has to be filled out. And also for your benefit, you can download a completed workbook, and that's for a nursery, Ann's Nursery, which has all the information. You can see what was input, you can see the financial statements that were generated afterwards, the break even, the ratio analysis, all of that can be downloaded so that you can look at the user guide, the blank workbook, and a completely filled out projection set. And again, it's all free and it's all from SCORE. And I honestly believe that I don't think that there is a better Excel workbook on the internet today, and it'll be great. Now, we're not going to go through the workbook here. We could spend an afternoon going through it. But you should know that it's out there. You should download the guide at least to take a look at how do I begin to accumulate all this financial information, because it will be very helpful and extremely useful as you begin to look for the financing that you need in order to get your startup off the ground. Now let's switch gears for a minute. The likelihood that your startup will get financed by a bank is frankly slim to none. In my over 30 years of experience, I only financed one startup. It was $1 million loan, and the only reason it got approved was that the founder's father was willing to provide his entire stock portfolio to the bank as collateral. And so not only did we have the stock certificates in the bank, but we also had him fill out stock powers giving us ownership of the stock, so that if anything went bad with the loan, we could sell the stock immediately and pay ourselves off. So for the $1 million loan, I had $1.5 million worth of stock certificates that were valued every day. And that's how a bank will provide startup financing. So let me help you understand a little bit about how a bank thinks, so this makes some sense to you. This will be helpful in your future as well as thinking about your sources today. So first, pretend that you're an investor, not an entrepreneur, but an investor, and you want to buy stock for your investment portfolio. You want to buy some public company stock. Well, you know that if you buy stock, particularly for new companies, you stand the risk of losing everything that you put in. That's kind of an understood. But partly you do it because you want to be able to participate in the upside of this business. I mean, you're hoping it's going to be the next Alphabet or the next Microsoft or the next Amazon. So you're going to spend the money to buy the stock, hoping to participate in the upside. Now take off your investor hat and now put on a banker hat. Now, when a bank lends a company money, they too could lose it all. The company could go bankrupt, there could be embezzlement, lots of different problems, and the bank could lose all their money. The bank, however, cannot participate in the company's upside because their upside is really limited or capped by the interest rate they charge on the loan. So if the company they lend to 4 years from now becomes the next Microsoft, they're still going to get paid back the same amount of money based on the interest rate in the contract. So they cannot participate in the upside. And because of that, they want two legitimate sources of repayment. The first one is always cash flow. So they will look at your financial projections, they will examine your assumptions, and then they will reformulate that based on their own experience, and they'll haircut what your assumptions are and modify them and come up with a conservative approach or a downside outcome. And if your cash flow is not sufficient to support the loan, at that point, they say sorry. But if it is, if they believe that even under a more conservative outlook, you still will generate enough cash to pay the bank back, they're still not going to approve it until they have a second way to get repayment. In other words, if the cash flow doesn't materialize, they still want to get paid back. And usually that is by liquidating collateral. And so they look to the collateral, and if there's enough inventory, receivables, and real estate assets or equipment assets that if they sold it in a liquidation, they could get paid back, then you get approval and you'll get your money. But you see, the startups have a problem. They've got two. One is that there's no operating history to be able to validate the projections. So they're taking it on blind faith. That's why they do a conservative recalculation of your projections. And the second thing is you don't have any assets. You know, you're applying for a bank loan in order to buy assets. And so the bank says, okay, you don't have assets, you don't have a history, and that's why they don't lend to startups. You may be asking, well, if that's the case, then where do I go? Well, here's the list. And there's two columns here. One is for equity, which signifies ownership, meaning that if you get money from these sources, you're probably going to have to give up a portion of the ownership of the company. And then the other category is debt, which is effectively loans, and you pay it back plus an interest rate or a factor. Well, let me just go down to this asterisk on guaranteed by the SBA, because it's kind of important to understand. First of all, the SBA doesn't lend money. What the SBA does is they guarantee loans that banks and credit unions make that qualify for SBA approval. So if you think back on that net working capital illustration I gave earlier, what the bank does, if they're satisfied with the cash flow, but they question the amount of collateral. I mean, they take a look and they say, okay, they'll have some raw materials that they bought. We could probably get, 40 or 50 cents on the dollar if we had to sell them in an auction. Now there's some work in process, so it's not a finished good yet. That's not worth anything to us. And then there's finished goods, which hopefully we might be able to sell to the existing customer base. And then there's equipment and real estate perhaps that we're going to have to also sell at an auction, because we can't wait too long under normal circumstances to sell this stuff, because that time is money to us. So they want to do it quickly. Well, if they've gone through the analysis and feel good about the cash flow, but they don't think that there's enough collateral support for the loan, that's where the SBA comes in. And the SBA says, we'll guarantee 75% of the loan. So the bank says, okay, I'm going to loan $100,000. I think there's only $50,000 of collateral that's likely to be reaped from a liquidation. So I'm $50,000 short. But the SBA is willing to guarantee 75 cents on the dollar, which now means I have $125,000 of collateral support, which includes the guarantee, for a $100,000 loan. It gives me a cushion. That sounds like a pretty good deal. I think I'll make that loan. So that's the role that the SBA really plays. Now let's get into a very busy slide. I put this together for a group of existing businesses in Chicago who believed that the conventional bank market was not accessible to them. They didn't have adequate access, and they were frustrated on where to go to get funding. So if you look at all of these sources, you'll notice that there is not a single bank mentioned here. So this is everything other than a bank, which is really appropriate for our startup conversation. Now we're only going to focus on those clouds that are highlighted in grayish blue. Those are the ones that have potential applicability to startups. The other clouds are typically available to companies that have had some track record of operating history, which a startup does not. So we're going to start right at the top of the page with micro lenders. Micro lenders are primarily intermediaries between sources of funds directed towards disadvantaged areas and the actual needs in those areas. And that's why most of these micro lenders are not-for-profit organizations and they operate very locally. Now, the Community Reinvestment Act requires domestic banks to lend to disadvantaged areas. So banks will contribute capital to micro lenders to provide them money to lend, but they will also participate directly with a micro lender as well in extending loans to companies in the areas that I talked about. And the reason they do that is that they get CRA credit for the year so that they can pass their regulatory test. So these micro lenders that I'm talking about are typically certified by the US Treasury Department, and they're certified as Community Development Financial Institutions, or CDFIs. And there are 950 of them in the United States right now. Now, some of these programs can also get support from the Small Business Administration and its microloan program. And that's where the SBA can guarantee up to 85% of the microlenders loan. And there are 32 such lenders in Illinois today. The key here is that your business needs to qualify because of low income or disadvantaged areas. And so it's typically very friendly to minorities and to women. And unlike banks, they are very much more friendly to startups. Now, my experience is that probably the vast majority of micro lending is directed towards real estate and real estate development. But that being said, it is available for startup companies for working capital and equipment purchases. Now, some of the loans are secured, and usually that's the real estate or equipment that secures the loan. Sometimes co-signers are required, but in many cases, the loans are actually unsecured. And typically, the loans are for $50,000 or less, but the rates vary significantly, as it shows here, 4 to 36%. So it depends on where you are in the situation that you're in. Now, those microloans guaranteed by the SBA in 2019, which was the last that I have available, was just under 15 grand, and the average rate was 7.5%. Now, on that very busy access to capital slide, I showed the 3 largest micro lenders in Chicago: Axion, Chicago Neighborhood Initiatives Microfinance Group, and CFA USA. Those are probably the 3 biggest. And if you want to find out more about micro lenders, I recommend going to cdfi.org, which is the coalition, which is a trade association that basically champions the cause for micro lenders in the US. So it's a great way to get a flavor of what the setting is and who the players are. The Opportunity Finance Network, OFN.org, that's a group of CDFIs that have banded together to pool their resources to help start up and early stage companies. So that's another place to potentially look into. But that's the story about micro lenders. Now let's go back to that busy slide, and the arrow is pointing to family and friends. This will surprise you, but family and friends invest between 50 and $75 billion annually to startups. That is 2 to 3 times the amount of money invested annually by venture capital or angel groups in startups. So those of you that say, well, I don't like mixing business and friends and business, and I get it. I get the point. But if you're a startup entrepreneur, you've got to step that aside and begin to think about this as a very important source of funding. Now, because you're participating in this webinar, as a follow-up after it's over, you're going to get a 5-page family and friends funding guide that was put together by Chicago SCORE. And it goes through a lot of detail about how to think about it, how to approach it, what's the right thing to do, the wrong thing to do, all of which will be very helpful to you in taking a look at this source of capital. Now, the trickiest part about all of this is that you really don't want to lose the money that family and friends give you, right? I mean, that's obvious. So you're walking this emotional tightrope by mixing business and family friendships. So my advice is go only to people who can afford to lose what they're giving you. I think that's the most heavily weighted criterion. You know, for portfolio managers, investment managers, pension fund managers, they will rarely, if ever, allocate 5% of the capital in the portfolio to any risky security. And it's usually less. So when you think about going to somebody who can afford to lose it, I'm really saying that they can afford to lose 5% of their net worth. So if Uncle Fred has $100,000 in net worth, you should only be seeking $5,000 or less from Uncle Fred, because that's the kind of net worth relationship that risky securities should embrace. And let's face it, a startup is risky no matter what you think. But you really want to take money from sophisticated and well-connected people. And the reason is they are going to ask you the tough questions. And those tough questions will ultimately benefit you and your company in the long run. Better yet, aim at individuals that have experience in running their own business. And they are the ones that understand what you're going through, and they can relate to what's happening. And if they have the capital to support, they're a great source. If a family member or friend has invested in an early stage or startup before, that's typically a very good sign. They would be a great target as well. But avoid taking dumb money. You want your seed investors, your first set of investors, working for you, because at some point they're going to help you get your next round of financing. You don't want to press someone who's uncertain, because they're going to be the first to complain when things get rocky. So avoid investors with high potential to cause drama and stress. You're going to have enough of that without them. Now, once you have identified some targets, here's some advice on how to make that work. And the first thing is to build a relationship first. Don't ask for money. Present your business idea. Maybe give them a copy of a business plan or an executive summary of it. And get them to understand what you're trying to accomplish, how you're going to go about it, and it will better position you to go back to them later to ask for money. But you have to be prepared. You should really have a good business plan, and it should include 2 things critically. One is that there has to be a validation of the market for your product in it. You can get that through market research and internet surveys. And that you also include the financial projections with the assumptions that go behind them. The other thing to really spend some time on, we'll get back to this in a minute, is to really identify milestones in your journey that can be used as triggering events for asking for money. Most of the capital that's raised from family and friends is loan versus equity. But that family and friends guide that you'll get will help you to determine which of those two approaches will work best for you. But as I said, most of the time it's lending from family and friends. But you need to put your cards on the table. Even though I'm sure you're very confident in the success, you have to be honest about the risks you face. Don't make promises you can't keep just to get someone to open their checkbook. And you need to make sure you demonstrate your passion for the business and the due diligence you did to validate your business idea. Having a good idea is one thing, but making sure that it's viable is what really attracts the money. So be upbeat and respectful, and certainly don't be negative or arrogant in the process. Make sure that you stay away from those two things. And you need to manage expectations. It's a best practice to periodically email your backers. You want to be honest about what's going on and what could be better. You may want or need to come back to them for more. And the whole reason for thinking about the milestones, as we'll get to in a minute, is that rather than asking for a big lump sum at the upfront request, is to break it into pieces that link up and align with the milestones. Investors and bankers don't like surprises. So you need to alert them anytime that there's an expectation change based on what you're facing. Now, this is a list of milestones, not just for funding. I mean, you could think about organizing your business plan this way as well. But I'm suggesting that these are amongst the milestones you might select from in order to divide your funding requests of family and friends, certainly. And it also gives you an idea of how to perhaps partition the requests of other sources as well. So proof of concept, that's where the thing you want to make is technically viable. You've been able to prove that. A key partnership, I think, is another good milestone. So maybe you've signed up a marketing firm to help you market your service or product, or you've hired an outside processor to manufacture part or all of what you're wanting to sell. Or maybe you've set up a distribution channel. Those partnerships are important for your success, but they're also triggers that might demonstrate to a family and friend that you're actually making some great progress and that there's some other independent outside party that is aligning themselves with you, which is a very positive and attractive milestone. Prototype is another milestone where you've demonstrated that you've got the know-how to make it. A lot of people talk about the minimum viable product. That's kind of a scaled down version of what you're actually going to produce. It doesn't have all the bells and whistles on it, but it's enough built that you can touch it and deal with it. And it's tangible enough that you can actually hand it to a family and friend investor and they can understand what you're trying to do. Beta testing, that's the final testing before you launch. And even the first sale. I mean, when I was growing up, I saw a lot of privately held companies that had $1 framed in a picture behind the cash register. Was first dollar earned. So again, the first sale is a milestone, but again, it's the reality of having done it. Might be another opportunity to go back to your family and friends and ask for that next round of financing. So that's family and friends. Let's now jump to donation funding. I'm sure you guys know a lot about this, and many of you are probably donors to a lot of these sorts of things. Crowdfunding, of course, is raising money through collective efforts of individuals and institutions that are coordinated through an internet platform. So these are probably the 6 biggest donation funding platforms in the country. And the one thing that you probably know is that any money raised through donation funding doesn't have to be paid back. It's a gift. Donation funding has helped launch over 1 million companies since it started in 2000. And like I said, those are the biggest players on that slide. Now, this is where a business plan is probably not going to be a whole lot of help to you. I mean, these platforms really attract donors that are interested in projects, they're interested in causes, that are not particularly interested in the business overall. And they might also be interested in a particular kind of product. So you really have to change your thought process in order to align with these platform populations. The number one thing is you've got to have a story that connects. And this is number one in my mind. Let me give you a great example here in Chicago. There was a woman that came to SCORE and she wanted to develop a transportation company for working parents where she was going to be responsible for transporting their children to and from school every day. And of course, the benefit is not having the hassle and trauma of having to worry about that transportation process every day when you've got to face work and get ready for it. So she thought she would really be a great startup. But as she was going through the process, she found out that she had to get insurance, obviously, for her car. And the insurance company classified her as a limousine service, not a transportation company, as she had hoped. And therefore, most of them were requiring a minimum of a $10,000 upfront payment because she was a startup and had no operating history. Well, she didn't have the money. So she went to the donation platform. And her story was interesting. It was kind of couched this way. I'm trying to help working couples who are constantly facing trauma with transporting their kids to and from school every day. And I will be able to do that. I'm qualified as a nurse and blah, 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 and I do this other stuff. But my problem is the big bad insurance companies are trying to charge me up front $10,000. And I don't have the money, people. But I think this would really help working couples here in Chicago. She got her money. It was the approach of the big bad insurance company that turned the tables. Now, each of these platforms has a unique approach, but most are interested in providing some kind of reward to the donor or the giver. So that could be as simple as the ability to pre-order the product or pre-order the service. It might be a discount on the first run. It could be as simple as a t-shirt that says thank you, or getting included on a donor list on the website. So the rewards things are important, and it's really, since it's a gift, it's a way to engage the donor in a way that might provide some emotional connection. The key thing here, though, is that you shouldn't be viewing this as a one-time event. You should look at the donors or givers as stakeholders that might assist you in the future. The platforms provide you with the donor lists, the dollars that they've given. They give you vehicles to gather contact information from them. They provide updates, or a vehicle to provide updates to the donors, and an ability for you to take surveys of the people that have given you money. So it creates a network of a contact set with the people that have given you money. And you can go back to those donors for a second round. Park Design is a creative maker of outdoor gear, and they have gone to donation funding 5 times in their short history. The last time they went, they raised $4.9 million. But here's my biggest challenge here. You need to create your own outreach program. You can't rely strictly on the platform to attract donors. You've got to go out and create your own excitement. You've got to contact your family. You've got to contact your friends, talk to potential suppliers, potential customers, people in your neighborhood. You want to gather as much excitement about what's going on with your donation program that you have a greater chance of reaching the target that you want. And if you only rely upon the network, I think you're doomed. You have to do a lot of this work yourself, and that's what really contributes a great deal to the success. There's 2 kinds of campaigns, either a fixed or a flexible. The fixed program is you set a bogey or a target of what you want to raise, and if you don't get there, you don't get any of the money. If you do get there or above, usually you will pay a fee of 4 or 5%. The flexible program, you also set a bogey, but if you don't hit it, you still get to keep the money. It's just that the fees typically double. And remember, everyone that makes a donation, there's some sort of processing charge. The platform may charge you a fee, a bank may charge you a fee, and collectively that might be another 1.5 to 3% that will have to be paid for fees. It's interesting though that the all or nothing campaigns get fully funded at twice the rate of the flexible ones. And if you really think about it, it makes a whole lot of sense. If you were looking to raise $50,000 and you get 48, you don't get anything. So you're going to work your hardest to get that 50 number or to make it more realistic. And you're going to garner your own network to approach the campaign at the website. And that's why it is twice as successful as the flexible ones. That being said, though, the fully funded success rate in crowdfunding is only about 50%. So there's a lot of times that you just don't get there, and some of it is because you're asking for too much, and maybe your campaign isn't strong enough. But as you can see, the average successful campaign raises $25,000 to $30,000. Usually, it's about 9 weeks of elapsed time, so that gets factored into your thinking. And the average pledge is under $100. The fully funded campaigns typically have as many as 300 givers. The biggest raise ever was $20.3 million on Kickstarter about 6 years ago. And Pebble Technologies was promoting its new smartwatch. So it was a product. It wasn't a business. They were promoting the smartwatch and they wanted money to promote it. And they were looking to raise $500,000 and they raised $20.3 million. Fitbit was watching that, by the way, because they bought that company 2 years later. So we've talked about micro lenders, we've talked about family and friends, and we've talked about donation funding as 3 very important sources of financing for startup companies. Now let's jump to angels. What I've showed here on this slide is the 6 largest angel groups in Chicago. Now, if you're not familiar with an angel, they are usually wealthy and successful business people who are interested in investing their own money in startups or early stage businesses. Sometimes they work alone as individuals, and sometimes they're part of a group. To really kind of visualize what an angel is, think of Shark Tank. Shark Tank is a great example of angels. And as I said, these are the 6 biggest in Chicago. Now there's a difference, a big difference between individual angels and angel groups. Angel groups are more formal, and they're typically really interested in the next big unicorn or big IPO. You know, that's really what they're looking for. By the way, seed capital, which is on this slide, it's typically the first round of fundraising. So family and friends, for example, would typically be a normal seed capital for a startup business. Angel investors are more interested in ownership. So they're not as interested in lending money. So if they do provide any kind of debt, it typically gets converted into equity at some point in time. But they're not interested in running the day-to-day operations. They want you to do that. And because of that, they are also only interested in taking a minority position, which is great. So you don't have to give up the majority of your company to get an angel to invest. But the vast majority of the angel groups do provide advisory help and mentoring support. And about 1 out of 3 angel groups will ask for a board position, one board position, because they'd like to be involved in some of the big decision-making of the company. But other than that, they're not interested in running things day to day. But they have a much shorter time horizon than you think. It's 2 to 5 years. They want to get all or a large portion of their money back within that period of time. So that's a key thing to recognize. And so they're looking for some opportunities that have exponential growth potential. That's really what they're looking for. So if you've got some aggressive plans, then an angel group might be good. The average individual angel check is under 40 grand. So keep that in perspective. And probably company valuation is at the center of success. I mean, you've seen that on Shark Tank, where everybody's arguing about the valuation. It's crucial. We're not going to get into that here. We could spend an afternoon talking about valuation processes for businesses. But just recognize that you need to come to grips with that in order to have any kind of successful dialogue with an angel or an angel group. It's interesting that angels see themselves more now as a bridge between family and friends financing and venture capital funding. So they see themselves sandwiched there in between, and that's kind of an important thing. The other thing is that more and more angel groups are using family and friends contributions as a screening vehicle. In other words, if you haven't raised money from family and friends, a lot of angel groups won't even consider you. I mean, after all, who knows you best? The family and friends that you have. And so an angel group who's new to the situation is saying, gee, if he can't get, family or friends to invest who know him the best, why should we consider giving them any money? So that's an important change in the way angels have been behaving. I believe that there's a greater chance of landing an individual angel investor if your business plan is not targeting a near-term IPO. So if you're looking for patient money, you're looking for your business to kind of grow and mature over the next, 7 to 10 years, you've got that kind of patient outlook, that's good for potentially an individual angel. If you're looking for some mentoring support, the individuals can do that. And if your time frame is longer like that, individuals are a much better match, in my judgment. But if your ambitions are more aggressive, then this is the list of things that you need to have in place in order to attract the attention of an angel group, let alone actually get capital from them. So the first thing is your product or service has to be developed or very near completion. That's kind of number one. They're also looking for you to have existing customers, or at least confirmed potential customers. They want to know that you've invested your own capital and that it's meaningful and that you've recruited family and friends funding. In your projections, they want you to be able to demonstrate that the business can grow rapidly in the next 2 to 5 years. So they want to see a hockey stick in your top line, and then the assumptions that support it need to defend that approach. And therefore, your business plan has to really be in top shape in order to get an angel group to legitimately consider funding part of your business. The way, though, that you get into an angel group, and I also suggest to get to an angel investors, is to network in. And so you go to the website, you take a look at the businesses that they have financed because they publicize that. You look at who's involved in the angel group and identify the people that are their advisors. And then you go to LinkedIn and you try to find a way to get an introduction to any of those people so that you can express your interest in your business idea and an interest in getting into a discussion with the angel group or angel investor. So it's network, and LinkedIn is a great tool for that. The Angel Capital Association, ACA, is the trade association that is representing angel investors across the US. So it's a great resource to find studies about the angel population, what the characteristics of those people are, what they look for. They publish white papers on many different topics that have to do with startup and early stage businesses. So it's great to understand the angel environment. Angel.co, believe it or not, is a place where you can post for a job in a startup, or you can recruit for your company people that are interested in working in a startup. So it's a great place for that. But also, if you go to this address, you'll be able to find a long list of individual angel investors throughout North America. So again, it's a great source of the individual investor. And that's where you, again, could identify someone and try to find others that you might be able to network in. And the Angel Invest Network is the largest funding platform, crowdfunding platform of angel money in the US. So they have, actually in the world, they have, what, 250,000 investors, and they operate across 80 countries. So it's a great platform. And there again, you will learn more about the angel environment. Now, we've talked about a lot of different pieces here, and I believe that it's often difficult to figure out how do they work together, or do they? And so one of the other things that you will get as a participant in this webinar is you're going to get a one-page picture on how startup funding works. And it takes you through the transition from bootstrapping all the way to initial public offering, and how all of these pieces, the family and friends, getting another partner, the angel investor, a venture capital firm, how all of those pieces fit together and then get modified as you go down the road to eventually an IPO. And I'm not suggesting that everyone here is going to be moving to an initial public offering, but it will give you, I think, a much stronger sense of how these pieces fit together and what happens to the founder's ownership percentage as he or she attracts capital from other sources that changes the ownership percentages as time moves along. And it puts it all into perspective and gives you a chance to determine, is my business suited for this track that goes to an IPO, or is it best suited to stick within family and friends and, you know, move along in a much more patient process? And then when I really need capital to scale, that I find that an angel or an angel group might be the most fitting proposition. So that basically covers most, if not all, the stuff I wanted to talk about in terms of startups. What I do want to do, though, is, since we've got a little time left, is go back to that busy slide with the clouds and talk about some of the clouds that weren't part of the startup conversation. So let's start with alternative lending. If you look at this slide, these are probably the 7 biggest alternative lenders. And what are alternative lenders are like crowdfunding. It's a lot of people that are gathered by these platforms in which they want to lend money to businesses. And On Deck, for example, is a big public company. And so they accumulate all the potential lenders, individual lenders, and then you apply and things move from there. But they're not for startups. I mean, these are companies that are looking for what they'll say is a minimum of 4 to 6 months of operating history. But the reality is they want a year to a year and a half minimum. And what they focus on is consistent monthly revenues. They're less concerned with how big they are, but more concerned about the consistency. And the reason for that is that they take money out of your account every day or every week. So they don't wait for you to pay them back. They take money out of the bank account. So that's why they're looking for the consistent revenue. If you have a lot of volatility in your revenue when you go to them after 1 or 2 years of successful operations, if you do not have consistent monthly revenues, you're probably not going to get the money that you expect. But the interesting thing is, if you read their websites, they say, well, we do not charge an interest rate. What they charge instead of an interest rate is what they call a factor rate. And you don't really find out what that is until you begin to apply and start to talk to them. But what it is a multiple of what you borrow is what you're going to pay back. And the typical one is about 1.2 times. And if you do the math, most of these are 6-month loans. So if you're paying 1.2 times what you borrowed within a 6-month period, the implied annual percentage rate is somewhere between 30 and 50%. So it's a lot of money. And for someone like me who's a baby boomer, I would never do this because I think those are nosebleed interest rates. However, millennials are using these alternative lending sites a lot. And how they think about it is important, because usually it's because they've had an opportunity to land a big account, but they don't have enough excess capital to be able to buy the inventory of the goods to be able to satisfy the order. But they know that if they get the order, it's a big name. They can publicize that to show that they're legitimate, and it might lend to some follow-up business with that big name. So they do the math and they say, okay, if maybe my gross profit on this is going to be 40% less than it normally is, but it's going to be a sales rate that's 3 times what my normal order rate is. So if I can build the product and it reduces my gross profit, but even after I pay the loan back, I still make a little operating profit. Maybe it's worth the effort. And if I can get it done in 3 or 4 months as opposed to 6, that's even better yet. So alternative lending is not for startups, but it's something to think about. And I think it's especially useful on a project basis rather than an ongoing basis. But you could have multiple projects. Think about that. Now, you may have seen Kevin O'Leary, who's Mr. Wonderful in Shark Tank. He's been all over the internet and all over TV publicizing startengine.com. And when he first started, he said, this is where startups can get money. And now he's saying, this is where you can invest your capital to get good returns with early stage businesses. So here again, these Reg CF crowdfunding equity deals are not for startups. But you should know that aside from Start Engine, there's over 50 of these portals in the United States right now. But in order to qualify, you have to have 2 full years of audited financial statements in order to file. And quite frankly, my experience is that even successful businesses don't begin to consider getting audited statements until the year number 5, 6, or 7. And that's because it helps them also with bank financing. So again, the purpose here was to give you a sense of some other sources that might be in your headlights once you get launched and have some operating history. The other one that I don't have a slide for is equipment finance. I mean, depending on the nature of your business, if you are needing to buy equipment, whether it's trucks, rolling stock, processing equipment, photocopy equipment, whatever the case may be, many manufacturers are also in the finance business. And the reason it works for them is they understand their product, they understand the asset values, they understand how the product will depreciate over time, and they know where they have to keep the loan balance in order to make sure that if they have to take it back from you because you can't pay back the loan, they've got enough cushion that they could sell it in a reasonable way and get their money back. So going to the manufacturer and trying to get lease financing is very useful. I think startups can do it. The other thing that's important to recognize is that it's 100% financing. You know, most of the funding that you get to buy equipment and stuff, you've got to put some money down. And sometimes it's only 10%, sometimes it could be 30%. But with a lease, you generally don't have to put down anything. So it's 100% financing. Well, again, you're going to get 2 things or 3 things as a follow-up. You'll get the slides from the show. You'll get the family and friends financing guide. And you'll get that picture on how startup funding works, all for the same price. Our purpose here was to learn more about how to fund your startup. I told you that we were going to cover a lot of ground. We were going to go an inch deep, but it was going to be a wide gap. And I hope that we accomplished that today. If nothing else, I hope that I helped make you think. I thank you much for signing on, and I will stay around to answer questions for as long as it takes. Back to our hosts.
A few questions that did come in. There were some questions about the website you first said in the beginning, like 2 slides, 5minute.com. They're asking if you could please just say the website one more time.
Yeah, it's 5minuteclasses.com.
Perfect. Thank you. Lots of questions on that. You must have been really making a good point with that one. I had lots of questions. I'm sorry, I'm just going through the questions. Can you repeat the name of the Chicago micro lender?
It's the 3 that I mentioned. One was Axion, which, by the way, is a national company, not just in Chicago. So they got offices all over the place. Also, the CRF USA, you can go to their website, and CNI, which stands for the Chicago Neighborhood Initiative, the CNI Microfinance Group is another micro lender in Chicago.
Okay, great. Another question. My brother has a convenience store and has a 5-year lease. The owner is selling the building. He would like to purchase the property and needs 120,000 and he needs 90,000. How would you best, what would be the best to get him that money? He is a startup under 1 year.
Well, I think that's where, in order to, first thing you have to recognize, if you're going to try to finance the purchase of the building, you're probably going to have at least 20% equity that you're going to put down. Could be as high as 25%, but certainly that equity has to be provided by you. So that's where, going to your savings, you could even borrow money from family and friends, so long as you can keep that away from a bank. That's the way to go. Financing, I think the property with a micro lender is a really good choice, because, as I think I mentioned, most of those micro lending loans are for real estate and real estate development. So I think the micro lenders are going to be a really good choice. The fact that the party's only been around for 1 year of operations is probably going to make it difficult for most banks to approve it. But you could go to a community bank in the area who might indeed be familiar enough with the location that if they believe that there's some inherent value in that, it might make sense for the bank to provide financing. So I think those are my first thoughts about how to advise your party.
Great. Another question. Any thoughts on government grants?
Yeah, I don't believe in them. I know there's a lot of advertising, there's a lot of stuff out there. It's a quagmire, and I've just talked to so many people that have worked diligently to try to find something, and I've rarely find anyone who has gotten government grants to do much of anything as a startup. I mean, if you're in business and you've got a new product or something that aligns with something, that's a whole different story. But for startup purposes, I'm not a big fan of grants.
Great. Next question. I have a non-for-profit that provides art as a form of creative healing to people who experience emotional trauma or feeling of hopelessness. What are the most effective ways to finance my non-for-profit?
I have to be honest, I am not very attuned with not-for-profit financing. So all I can say is the stuff that I've talked about today is a place to start. But again, the micro lenders recognize that they themselves are not-for-profits. And so there's an alignment in the issues that face their business along with yours. So that would be a place that I would start. But beyond that, I'm frankly not very tuned into not-for-profit lending.
Where is the best place to look for starting a tech startup other than family and friends? I just need capital to have the website and app platform built.
Well, there's a couple of places that you can think about. In the other workshop that I do, I talk about incubators in Chicago. So incubators might be a potential source if you put in incubators in Google Bing and then put Chicago or Illinois, you'll probably get a list of a number. These are companies that want to help you hatch your business, and they can provide some nominal capital on occasion. But they might also, if they like what you're doing, might be able to give you advice, and some mentors and people there may be able to redirect you to places that might help you to build the technology you're looking for. But aside from that, I think going to the places we've talked about, and I think the picture will give you 1,000 words of understanding. The family and friends and bootstrapping is what most will do to accomplish what you're looking to do.
Great. Another question. Can you recommend how to determine build out cost?
Build out costs like in a retail store, is that what they're talking about perhaps?
Doesn't specify, but that
Yeah.
will work.
Okay. Well, again, I think what you wind up doing is, depending on if it's a franchise, it's a whole different thing, because you should be getting help on that. If it's a build out as a individual standalone, I think you just wind up trying to get some great recommendations on people that do this for a living and ask them to come in and work with you on some of the ideas that you have for what the build out should look like. And then they can advise you on things that are feasible or not feasible and give you some idea about the costs. And it's, you know, it's a journey, understanding, but I think that's where I would start. I would start to get some of the contractors in and say, here's what some of my ideas are. I don't have plans, and begin a conversation and learn from that. And at some point in time, when you really have your thoughts together, after visiting with 2 or 3 of them, then you can go back to them or someone else and say, now I'd like you to develop a plan and give me cost estimates. That's how I would approach it.
Question. Can this be applied to businesses that are looking to get into real estate, buying properties to rent out?
Yeah, I mean, it could. I mean, I don't think angel investors are really interested in that. Certainly the angel groups, I don't see them doing it. Individual angels, they might. You'd probably have to go through 50 to get one, my thought. But at some point in time, you know, the bootstrapping, your own personal savings, and family and friends, or taking on a partner, that's another choice. You bring somebody on that has capital themselves, then that helps to fill some of the bucket. But it's hard as a startup to go to a bank, who, even a community bank that lends money to buy income properties, if you don't have a track record. So you've got to establish the track record first before you can go to a bank. And so that's why the family and friends and bringing in a partner, I don't like to recommend, you know, getting a personal loan or a home equity loan. I just think my own personal view is you need to keep your business and your personal assets separate. But I still think those are viable choices.
This might be a question for you. I moved to Chicago, from Chicago to Texas. Does SCORE provide info to all states?
Yes, the answer is yes, especially now that a lot of things are done virtually. They can submit all they have to go is go to score.org and put in their zip code, and then the website will actually match them to the closest SCORE chapter within their zip code. So yes.
Beth, how can I get money for payroll aside from the PPP? Thanks.
I don't consider PPP a source of funding for a startup, by the way. You get money for payroll from cash flow or from, investment capital that comes from yourself or family and friends. So, I mean, if you're trying to bridge a payroll, then, that's a much different question. I mean, if you're already operating a business and you're looking to find payroll money, if you don't have working capital from a bank, then, you've got no other resources than out of your own pocket or to get family and friends to contribute.
How would you be able to acquire a property that is city or state owned?
I don't know anything about that, quite frankly. I'm sure you can.
For the city, you could go on the cityofchicago.org and go to the Department of Planning and Development. They should have a listing. The state, I'm not sure. Jeff, next question. Do you recommend going back to the same lenders that denied you previously after milestones? Is the continued effort waste of time or reflect negatively?
Well, first of all, it's never a bad thing to go back to somebody who said no. There are many situations in my 35 years as a banker where people that I've said no to or the bank said no to, we eventually got together because the circumstances change. And so the key thing is trying to do your best to understand why the no was given. And it's not easy. But that's why really working on a relationship is important, whether it's your family and friends or your banker or your accountant, it doesn't matter. So the closer the rapport you have, the more likely you are to get the real story. Obviously, if someone in the bank didn't feel comfortable with your business acumen, that's different than someone who said, I don't think their business idea will fly. So if you understand the difference there. So it's really critical, but I would never rule someone out. People do that all the time. And they say, well, private bank never said yes to me, so I'm never going to go back to them. And all you wind up doing is limiting your options going forward. Things change, leadership changes, circumstances change, and it's always important to keep the dialogue going, unless there's something that's what I kind of said was personal, that was at the center of the decision.
Just a few more questions. Is there a resource that can help us understand the different financial tax responsibilities for the type of businesses that we have? LLC, S Corp, 501c3, etc. I'm trying to figure out the best business type to provide my services, raise revenue, and save money.
Well, I get the question. I mean, there's no simple answer to that, really. I mean, the LLC is probably gives you the most flexibility in terms of how your taxes can be dealt with. I mean, it can be done as a sole proprietor or a partnership or a corporation or whatever. You've got all the choices. A C Corp is different. You've got either a C corporation tax rate, or you can select the S Corp option, which puts the profits on your personal taxes. The difference between a charity and the rest is, you have to qualify for a charity, and a lot of people apply and they don't qualify. So you've got to figure that out. I think the best way is to get in touch with a tax accountant and begin to say, here's my business idea, my business concept. And that first visit is likely to be marketing purposes for them, and they probably won't charge you. And you probably get a lot of good information.
That's a great job. Great job. Thank you. Thank you for your time. Hannah, if you want to say a few closing words.
Thank you so much, Geraldine and Jeff. Thank you so much. Outstanding presentation as always. And one of the things that come up when entrepreneurs come to our office is that many of them share that they don't even know where to start when it comes to funding. And Jeff, you provided a lot of candid tips and insights that are tremendously valuable. And I know that a lot of this, because you shared what works, you shared what to avoid, and this can really help a lot of entrepreneurs save time, money, and unnecessary headaches. So thank you so much for that.
You're very welcome, and I hope everybody enjoys the slides once they get them, and hopefully it refreshes your memory of today, and good luck to everyone.
Yes, and to those of you who joined in today, thank you for taking the time to really invest in yourself and your business growth. Remember, you're not alone. The City of Chicago and SCORE Chicago are here to support you, so please stay connected with us. Keep attending these events and webinars, and schedule that appointment with our SCORE mentors. At SCORE, the mentoring sessions are always free, they're always confidential, and can be scheduled at chicago.score.org. Again, Jeff, Geraldine, and those who are attending, thank you so much, and hope you all stay well and safe, and I'll talk to you again soon. Thank
Have a
you.
great day.
You too. Bye for now.